Welcome. We are awaiting one of the last meaningful pieces of economic data before the Fed decides on interest rates at next Wednesday evening at 7 p.m. We get the decision on interest rates in the US economy, and that's almost certainly going to be expected to be one of the last meaningful acts of Janet Yellen in her post as chair of the Federal Reserve. Today, in 5 minutes' time, we will be covering the non-farm payroll numbers. We are looking there for numbers that show something around about between 195,000 and 200,000 jobs having been created in the last month. These are November figures, of course. The spread there on the Bloomberg terminal is for anything between 150 and 260,000 jobs having been created. So anything between 195 to 200,000 is somewhere in and around the average there that we're looking for. In terms of the unemployment rate, expectations are this is going to remain at 4.1%. But I think the spread on the Bloomberg goes anything for between 3.9 and 4.2%. So we're looking for a 4.1% print on the unemployment number. And also in terms of the jobs, the earnings number, the month-on-month figure is expected to have risen from flat to 0.3%, and that could well take the year-on-year figure up from 2.4% that we saw year-on-year through to the end of October, up to 2.7% for average hourly earnings. So this is important because this is part of the reason as to why we've seen the Fed raise interest rates recently. They're worried about the fact that the US economy is beginning to heat up, and don't want to see a wage price spiral. So they want to keep the lid on that. Also, of course, we've got one eye on some of the background inflation numbers that we've got in the US. We've got inflation figures out next Wednesday, just before the Fed decides on interest rates. We're looking there for a print of around about 1.8 to 2% on inflation. But today is all about these numbers that we've got out on the US jobs picture. And let's introduce our guests here in the studio. We've got Gaurav Sharma, who's International Business Times business editor, and Josh Mahoney from IG, the analyst desk here. Gaurav, first of all, what are you looking for from these numbers?
You know, if you go by conservative estimates, of course, we look at some about 4%. If you go by some really optimistic estimates that's just sort of doing the rounds around the city, we could have, the headline figure drop to about 4% or thereabouts.
On the unemployment rate.
On the unemployment rate. Yeah. And if we could go as low as 3.9. Now, if that happens, and I caveat, if that happens, then we would have taken the rate down to its lowest since the year 2000. And that will be quite a feat. Now, another caveat that we need to attach is the wage growth. And the wage growth is actually not in step. If you look back at when the rate fell this low in 2000, the wage growth was somewhere in the region of 4%. Right now, it's lurking in the mid to high 2% ranges. Yeah.
Okay, Josh, what's on your radar ahead of these numbers?
Well, usually anytime you see big economic data, you're going to see that reflected heavily in terms of the US dollar. And the dollar picture, I think, is a really crucial one at the moment. Now, of course, if you're looking at what's happening with euro dollar, we had that head and shoulders formation. I just want to show you guys what we're looking at here, because you've got this potential head and shoulders, which points towards a possible bearish picture on the breakdown below your sort of 92.30 kind of mark. But if you look on the weekly time frame, we've actually got the potential for a very positive year. If you look at what's happened in terms of the rebound from around about that trend line support, we've seen that strong rebound. We've pulled back into what was the previous support area around about 92.50, and now we're starting to strengthen. So certainly we're not out of the woods in terms of saying this is a bottom for the market, but if we did start to see another couple of weeks of serious upside, then we could start to move into a position where certainly if we break up the 94, 93 mark, could actually turn into 2018 with a lot more of an optimistic outlook for the US dollar.
Okay, all right, we've got about a minute to go before we break those numbers for you. We're live across Facebook, YouTube and Periscope, of course, also along on the client platform and IG.com. We are following these markets up to the release of this November report. Just want to quickly revisit the IG platform and take a look at where we are in terms of the equity markets, the broad market index, the S&P 500. Quickly show you what's happening on the hourly chart as we go into this. And the markets at the moment are trading at the highest they've been since Tuesday this week. So that's where we are in terms of the move up at the moment on the S&P 500. Josh is watching the US dollar. In amongst some of the other figures we'll be watching, be taking a look as well at some of the background numbers, depending on whether or not this is a good or bad number. We'll also take a look as well at what's happening with gold. We're expecting these figures to come out 200,000, 195 to 200,000 is the headline number that we are looking for for this print, along with a 4.1% unemployment rate. And the numbers are due to break any moment now. Just a quick update, if we can bring up a chart here on the figures for the euro dollar, 228,228. And we are at the top end, or no, towards the top end of expectations, 228, comfortably under the 260, which had been the very top end at 260. The previous number has been revised up to 244. And the unemployment rate is 4.1%. Let's take a look if we can get anything else in terms of the average hourly earnings. 2.5% is average hourly earnings. So again, this is not as strong as had been expected. We'd be looking for a 2.7% print. I don't know yet what the average is for the month on month, but that's the year-on-year one. 0.2% is the number that we've got, which gives us indication as to where we are on the average hourly earnings for the weekly figure. You can see this rise that we've monthly figure. You can see this rise that we've got at the moment for euro dollar on this minute-by-minute chart, as we see money going in to the euro at the expense of the US dollar. Just a snapshot of where we are on the Dow Industrials on an hourly, on a 5-minute chart to give you a better idea as to what's been happening. We've got a little bit of a spike up as well, and the activity on the long side on the Dow Industrials. So that's the response to these figures that we've got, where we are looking at the moment at numbers that would seem to indicate that we are at the moment trading with the dollar slightly weaker and the markets, the equity markets, slightly higher in the wake of these figures, where we've got that print of 228,000. Let's take a look at these numbers out from this jobs report now from November with Gaurav Sharma from International Business Times. What do you make of these figures that we've got?
I think it probably doesn't have a material impact on what the Fed is going to do next week, but I think it comes as a little bit of a surprise now, given what the forecasts that were out doing the rounds in the city.
You were looking for possibly a 4% print on unemployment, and you were mentioning that, in fact, before, when we saw 4% at this level, I think, what, 2000, that the average hourly earnings were something like 4%. Here we have average hourly earnings at 2.4%, substantially lower.
That is very disappointing.
How significant is that, where you are looking at the Fed, which is in the process of raising interest rates? How convinced are you that even these numbers are going to see a continuation of this policy of raising rates into 2018?
I think it would probably not have a material impact in the immediate rates decision that we have next month. But I think 2018 will be all about how Mr. Powell responds. And I think the way I see it is that he'll need some more data to come in before he has an adequate response to it, as to how he formulates his very public stance, which of course has a bearing on sentiment. I think a lot of the debate right now has been about Mr. Powell himself, that he doesn't have a PhD, and quite a lot of nonsense, very frankly. But once he hits the ground running, I think we rewind the clock back to when Bernanke first took office, and people are comparing and contrasting how his stance is, how his response is to breaking news, to data, and his formulation of his policy compared to Greenspan. So we'll have that same contrast drawn between him and Yellen, and finally, thankfully, next year the debate will turn to how Powell will respond to the data climate than what the man is about.
Yeah. Okay. Josh, what are you seeing in terms of some of the moves at the moment in the market? So we got the initial reaction was for dollar weakness.
Yeah, so essentially people have seen this as a negative. If you look at the overalls on the payrolls numbers, you can see that this month this current number has been revised, or has been better than expected. The previous has been revised downwards, so the expectation sort of net is very close to pretty much where we were anyway. So by and large, that I think can be pretty much ruled out. People are looking towards what's happening in terms of the average earnings, and that's been the disappointment. So that's what's being reflected here in terms of the US dollar. We saw the same kind of thing in terms of gold. Of course, we're seeing that initial weakness for the dollar and then strength for gold, but now we're actually starting to see that reverse. So in actual fact, by and large, yes, we're seeing that initial slight bit of weakness, but as we've been alluding to, it's going to make no material difference to what's happening in terms of the Federal Reserve. 98% likeliness that they're going to be raising rates earlier today, the markets are looking at. So I don't think that's going to really change whatsoever. And like I said, if you look at that wider perspective in terms of the US dollar, there is still a possibility we could be coming into a period of strength. Looking at Wall Street now, ultimately, generally you would see the likes of the Dow actually responding well to good data, negatively to negative data. It's not necessarily as reliant on the FX side as you see with some of its European peers. On this occasion, we've seen it rallying, and ultimately that is the trend that we have been seeing of late. If we look just quickly onto the sort of wider picture, you can see on the 4-hour chart here, we're moving back into a more positive mindset following that retracement into the 76.4. So it looks like we're hopefully going to continue on that vein and hopefully reach those all-time highs, 245.35 in the near future.
Okay, Josh, thanks so much indeed there for that. Gaurav, I want to return to you, if I can, to take a look into more detail about what's happening on these currency markets in the context as well for sterling, because we've had this news out today that they seem to have opened the door for the next stage of the Brexit negotiations. As sterling has been something you've been following. We've been up above the 135 level this morning, currently trading at 134. What's your view on sterling? What are you looking at when looking at the sterling dollar cross?
I think most people are saying this was a cross to watch out intraday today. And I think the way is that the morning started with this Brexit breakthrough as it was pitched. But I think as soon as people started reading the fine print, people said, well, you know, it's still early days to uncork the champagne. So slowly and slowly the sterling started responding, and of course people were watching out for the NFP data to come out and how the two match up or square up. I think there's still some concern over the sterling. I think it overshot itself when we touched 135, and I think the response is now evident. But I think there are a few more twists and turns, and we might see a response to that next week, of course, after what the Fed does.
And with the Bank of England, Fed and Bank of England next week. As I say, we're already looking at an interest rate rise potentially from the Fed. Bank of England, I haven't heard anybody that says they're going to raise interest rates. Interesting to see what the spread is, bearing in mind we saw 7 people vote for a rate rise last time.
Well, I suspect there's going to be no move there, because I think, and again, it's my personal opinion, not that my publication, I think they primarily reversed a cut that was really not needed last year. It brought us back to where we were. So the Bank of England responded to the wider sentiment that they had to, you know, introduce a rate hike. But I don't see any. There seems to be very little consensus out in the market that the Bank of England might move further on that.
In terms of sterling trading, Josh, we've got this what would appear to be an uptrend today. Yes, we've seen a little bit of a setback, and in fact, on the chart that I've got here, for my chart at least, I drew a line from the low that we had back on the 24th of August. We've got a couple of touches of that. We're now trading below that line for what it means, but this would still appear, if you look at the chart, to be an uptrend.
Yeah, certainly in the long term. I mean, 2017's been a particularly bullish year for sterling, but you know, I guess it all comes down to how you perceive these Brexit negotiations to go. Now, we have got through the first stage of those. Of course, the payment was settled on, but the Irish issue, I think, is going to come back. It seems like they've basically said, okay, well, down the line, we promise we'll please everyone, but they are, as far as I know, haven't come up with an actual solution of how that's going to work. So I think that's going to return. You've already heard people on the EU side saying how this coming trade negotiation period is going to be even harder than the first part. So I think as we go on and as we see which we have seen, the indicators turning lower, certainly in terms of the sentiment side, be it business sentiment, consumer sentiment, I think that's going to be a drag on the pound. And as we're looking in terms of the potential for a rebound in the dollar index and the dollar as a whole, there is a possibility that we could see that negative sentiment come through. So for me, the short-term sort of positive surprises that we're seeing in terms of the pound don't really detract from the fact that I think that we've seen pretty much a whole year of upside for the pound. I think soon enough that's going to come, it's going to be unravelled. And if I just quickly show you on a weekly time frame exactly what we're looking at here, you can see we're clearly channeling upwards. So the level would need to see broken, and bearing in mind this is a more long-term picture, 130.39. We break below there. And certainly if we fail to break this previous high at 136.55 before that, then that could really see some significant downside. But for the time being, it's trying to see if it can continue on this current vein and continue this upward channel. But I guess today was a buy the rumour, sell the fact. I mean, people are looking for where the next good news story is around about the pound that's going to prop it up. And I don't see anything for quite some time.
One of the things actually, Gaurav, is inflation that the Bank of England's obviously watching. Part of the reasons why we got, in fact, most of the reason why we got this inflation is because of the drop in sterling on from the Brexit vote 18 months ago. But of course, as we said, sterling has recovered since then. One of the other aspects, of course, that all central banks will be watching is the upward pressures on inflation that come from oil. And when we spoke last week about the OPEC meeting, what are your thoughts now on the price of oil? Because I think at some point, a couple of weeks ago, you were talking to me about the need possibly to short the markets as they were. What are your thoughts on where oil should be traded?
I'd say I'm long term, I'm still net short, but what I would say here is that the OPEC put, as you might put it, it has unraveled even before it really took hold. Because for the simple reason, as we conversed from OPEC over the course both before and after the event itself, is that there was an near immediate response to higher oil prices from the US drillers, because the rig counts responded, and suddenly the market thought there'll be more US oil in the market, and that dragged both oil benchmarks down, whether you look at US crude or you look at Brent. So in the inflationary impact of oil is what it is. I think it won't have that much of a bearing. In fact, what I would say is that Theresa May and Trump are actually quite lucky that oil is where it is. Otherwise, the inflation scenario would have been a lot worse than both countries are currently facing.
Yeah, it's interesting actually looking at a chart of Brent. We got a little bit of an uptick in today's trade. That's the daily chart for Brent. The hourly chart, you can see, in fact, there's been a lot of activity pushing it up. 63.15 is where we are at the moment. Josh, if I could quickly push you to talk about the technicals around some of these oil markets. What are you watching? I think on a daily basis, you do look at Brent, don't you?
Yes, I look at Brent all the time. So this is a weekly chart. I just thought it'd be interesting to show this long-term trend line. You can see what was previous support turning into resistance, come into that area. And certainly we've now got this period of consolidation. There are some question marks. It's a similar kind of story to what we were talking about in terms of the UK, right? Where's that next good news story going to come from? I think as you see higher prices, so you're expecting to see higher output from the US. And of course, there might not be 100% conformity rates from those people that do agree to make those cuts in the first place. If we look at what's happening on the shorter time frame, you can see on the daily we're pretty much range bound 6104 to 6457. So it's really going to be about the breakout from this range to give us the sort of next part of the story. For the time being, as we can see at the back end of this week, we're just waiting for that breakout, and until then people seem to be quite happy to be playing this range.
Yeah, okay, all right, Josh, thanks there for that. Just coming to the end of the programme, Gaurav, I want to get back to you, main guest today. What's your takeaway then, in a few words, from today's jobs report in the context of the interest rate decision next week and the view of 2018?
In the wider scheme of things, I concur with Josh. I don't think it's going to have a material impact on the events that would unfold next week. I think what the takeaway from this would be, this stream of data, if this continues, the trend continues into early in the new year, how would the new Fed chairman respond to it? And I think that's what all eyes are on, all policymakers' eyes are on. Now, is he going to be more policy wonkish like Bernanke? Is he going to be more reactive like Yellen? He might be a mixed bag of both, or he might well be his own man. After all, people keep holding it back against him that he doesn't have a PhD, so maybe he might do something more management-ish with the Fed.
Okay, all right, Gaurav, thanks indeed for joining us. Gaurav Sharma from International Business Times, and Josh with us, IG analyst, with a look at some of the technicals in the market. Just to very quickly take a look at where we are in terms of the S&P 500. The tick up that we've got here on the far right hand side of the chart is an hourly candle. You can see that at the moment, at least, we are at the highest point in these markets since the beginning of Monday's session. So it's been a positive twist to the markets, the equity markets today, this news, and we continue to see money going in to the euro at the expense of the US dollar. We've got 228,000 jobs having been created in the US economy in the month of November. We've been looking for something around about the 195-200 level, so that was better than had been expected. But the average hourly earning is coming to 0.2%. We've been looking at 0.3% print month on month, and a figure closer to 2.7% year on year. We got a 2.5% print there for the average hourly earnings on an annual basis. 4.1% unemployment rate, that's pretty much as expected. And that's where we leave things for this live bulletin, having traded these markets throughout the publication of those non-farm payroll figures. Don't forget, at 1:30 next Wednesday, there is the release of the US inflation picture, and we will be live on Wednesday evening at 7 p.m, in fact, 6:45 on Wednesday evening, as we go up to that decision from the US Federal Reserve on interest rates, the last meeting of 2017 and the last substantial meeting for Janet Yellen, and her legacy for the Fed is likely to be another rate rise come Wednesday evening. That's where we are at the moment. Do join us on Monday morning for the next edition of IG Live, as we take you through some of the early calls that we have on IG as we look ahead to Monday's session.
The new IG trading platform, fewer clicks, flexible layouts and time-saving settings, split charts across multiple timeframes and discover price change alerts, orders to part close, an integrated Twitter feed and more. Try IG trading now at